G'day and welcome to this week's video. I'm doing this after hours, so please excuse the civvies. But yeah, the inspiration struck, so I thought I'd go through a quick video. And if you haven't already done so, please subscribe to the video because it really helps us educate people out there around finance. It's something we're passionate about, and education is key. So please subscribe if you already haven't done so. Today's chat is about ways to cope with volatility. We're going to do a podcast on it a little bit later tomorrow, but going through and working out, and this is I suppose a case scenario, live case scenario that I had a chat with a client last week where we're talking about volatility and how do we cope with it, how do we come up with strategies to come around it, get around it. We come up with three strategies to chew on, and one is often what they call bucket strategy, where you still invest into growth assets, but you take a certain amount of conservative assets and you put them, those conservative assets might equate to 3 to 4 years worth of the income that you need to spend. And that means for the coming 3 years that you've got the income set, and that income, the cash is there to support that income needs for the coming 3 or 4 years. It can be 5 if you want to be very conservative. It means you're never in a position to sell any of your growth assets. Now, that was strategy number one. Strategy number two could be where we set up an annuity, and again it's taking assets and putting into a conservative area where this annuity will pay a regular amount for the coming 5 or 10 years, and it can form say half of your income needs over a set period of time. It can be 5 years, 10 or 15, whatever you like, and that really sets in stone a large percentage of the income that you get. And at the end of the day, income is what we need to go and have fun and catch up with family, do all the good stuff to live. So that's a strategy, but in both of those strategies, it takes a lot of money, puts it away into conservative areas. And there is an opportunity cost with that over the long term, not the short term. And probably in both those scenarios, particularly the bucketing strategy where you put cash aside, we aren't doing it for really over 5 years. So setting aside good cash reserves for the coming year's pension payments is a great idea. Like the annuity, that could be a 5-year or it could be a 10-year, depends on the preferences and how much of the income that you cover each year in the annuity payment. So the amount you invest goes into a conservative area, guaranteed area, where it will pay out as the quote says. This particular client, highly intelligent, loves watching the market, but the volatility over the last couple of years, really did stress him out. And this is a guy that would watch the portfolio very regularly. So the strategy number 3 is to stop looking. Don't look as hard. It means if you're not looking on a daily basis, you don't see all the ebbs and flows of the markets, and that's what stresses people out. If they looked at their portfolios once a year, once every 2 years, and I think Buffett famously said that, geez, it'd be lovely if the market would close for 10 years. They would open up, we'd do our trading in one day, and then we'd go about our business for the coming 10 years. But it's not the way markets work. It's not the way media works, technology works. We've got all this information at our fingertips. But by not looking, not focusing on the ebbs and flows in the short term, I think that provides far better results from an emotional point of view. And if we just let businesses do what they do, and that is to improve their products and services over a long period of time, and they execute that, not all businesses get it right, but the majority do, then you don't need to know what's happening in the short term when you're focusing on the long term. Thank you for listening, and catch you next week. Bye.